We're in stage 5. Say it out loud and feel the shape of the sentence. Not a forecast, not hysteria, but pattern recognition. The claim is simple and fierce. When a mature, credit-loaded market reaches a stage where price moves are driven by belief rather than fundamentals, the mathematics of leverage and liquidation begin an 18-month countdown to where most damage happens. In 1929, the clock started ticking in September. By March 1931, the devastation had taken shape. By 1932, the bottom had been found, but only after nearly everything that buffered ordinary lives had been stripped away. Listen, history is not gentle. It rarely repeats exactly, but it rhymes with ruthless precision when the same set of incentives, the same leverage, and the same behavioral certainties are present. That's what we're tracing. A sequence of human choices amplified by financial engineering and social psychology. The numbers, the mechanics, the timings, they form a script you can read ahead of the headlines if you know where to look. September 1929, the Dow at an all-time high. Newspapers cheer, economists proclaim a permanently high plateau. Yet beneath the optimism, something else moves. Insiders quietly liquidating, margin debt swelling into a dangerous ratio of GDP, corporate earnings peaking and beginning to slip. The market had become an edifice sustained by faith. Faith every buyer becomes a future seller at a higher price. That faith works until it doesn't. When it cracks, leverage and forced sales turn a crack into an avalanche. Fast forward to November 2025. The surface looks familiar. Indices near record levels, glib narratives about a new era of permanent growth. Today it's AI. In 1929, it was electrification and new industry. Beneath it, the same structural signs flicker. Corporate insiders selling at elevated rates, margin debt near historical thresholds, valuations priced for decades of uninterrupted growth. A titan sits unusually patient with enormous dry powder, hundreds of billions of cash waiting on the sidelines. That patience isn't indecision, it's optionality. It is what separates someone who wants to weather the storm from someone who wants to buy it at basement prices. Here's the core mechanic you must carry forward. Leverage is deterministic. When a market is leveraged, whether through margin loans to retail investors, leverage in funds, or banks using short-term paper to fund long positions, price declines trigger margin calls. Margin sales force prices lower. Lower prices, more calls. The process is automatic. It does not negotiate with narratives despite how persuasive talking heads may sound. It obeys math. In 1929, margin debt reached roughly 8% of GDP. A simple threshold that is not mystical, only consequential. A small market move becomes a knockout punch when much of the ownership structure is built on borrowed money. Today, margin debt and structured leverage are different in detail but similar in effect. When leverage is high across the system, corrections are no longer mere corrections. They are the beginning of an unwind. But this script has beats that repeat, which allows us to map months to months. In 1929 and 1930, you can see a recognizable sequence of the initial crack, a frantic rescue, a dead cat bounce, months of grinding losses, bank failures, social distress, then an acceleration into capitulation. The devastating part, and the part the market's PR machine always disguises, is the lull between shocks. That lull convinces people to re-enter, to rationalize, to swap fear for hope. It's the psychological trap that turns damage into disaster. This is not to traffic in inevitability. Numbers change, policies act, unpredictable shocks happen. But there is a reason veterans of financial panics use the same words: distribution, liquidity, margin, across centuries. When human incentives repeat, so do patterns of outcomes. That gives us a math. It gives us a sequence we can overlay on the present to see what to watch for, what to fear, and what might offer opportunity. So here's the promise of this narrative. First, I will walk the months from September 1929 through March 1931 in detail, not to glorify doom, but to show precisely how the process played out month by month, how the social and economic feedbacks amplified market moves, how policies reacted and failed, and how ordinary people were shifted from the center of prosperity to the margins of survival. Second, I will lay that template over 2025 to 2027 and point to the concrete indicators that match the old script: insider liquidity events, margin expansion, valuations divorced from earnings, credit strain in specific sectors. Third, and most important, I will show the practical timeline, the windows where de-risking matters, the phase where false hope is most dangerous, and the capitulation where long-term fortunes are made by those who survive. A few cautions before we dive. This is not an exercise in fear for fear's sake, it's in attention. Pattern recognition is a survival skill as much as an intellectual one. Second, the mechanics we describe are amoral. They redistribute wealth without malice or design, they simply respond to incentives. Third, people who prosper through these periods don't do so because they deserve it. They do so because they had liquidity, conviction, and the ability to act when others could not. That's the cold, uncomfortable truth about generational wealth. So, set the stage with me. The market's music is loud, the dancers are in motion, and somewhere behind the orchestra, a handful of players are quietly moving their chairs to the exits. In the next sections, we will watch the tempo change, the steps misalign, and the floor open.